Hey everybody, I hope everyone is doing well and had a good day. Today we're going to review the E-mini S&P 500 5-minute chart for Friday, August 21st, 2026. Let's take a look at the daily chart so we have some higher time frame context and some expectations going into the day. Strong bull breakout above a trading range. Weak reversal, expecting a second leg up. The market channels to a new high, but we find sellers at the new high. We get a strong micro channel down, expecting a second leg down. We get a pullback. We're getting a second leg down here over the past couple days. Yesterday, strong bear trend bar. On the daily chart, we know it's a bear trend day, which I'll talk more about on the 5-minute. What's the expectation going into the day with the current price action? I have this line drawn here. This is the June 15th high, the top of this trading range back here when the market was sideways for a lot of bars. This is a breakout point. The market broke above it. We have not come back to test it yet. We're getting close to it yesterday. My thought was there's probably buyers here. This was a trading range for a lot of bars. Traders selling in the upper third of this range were making money. We test resistance, sell off, test resistance, sell off repeatedly. But this time we broke above it. So anybody selling here gets trapped by the bull breakout, and that creates support. So probably buyers at this breakout point. So I'm expecting buyers below yesterday's low if we get there. However, the approach is fairly strong. It's a tight bear channel, not a lot of buying pressure on the way down here. So there might be a minor reversal, but the bulls need to do more if they're going to get a reversal back up. And then for selling yesterday, trend bar, it's a bad stop order buy signal bar. So if we get above yesterday's high, I expect sellers above. Also, in general, I'm expecting sellers in the sell zone of the bar, so the upper half of the bar. On the 5-minute chart, trading range for the first half of yesterday, we end up getting a strong bear breakout. And this is a tight bear channel, followed by a tight trading range. And I mentioned this might be a final flag. Whenever there's a tight trading range late in a trend, it's a possible final flag. So the market breaks out, trying to resume down, but this was an area of agreement, and markets are resistant to change. So we get the breakout attempt, but then we end up reversing up here with the gap up going into the day. And now we have a big gap up. I say big gap because the average daily range over the past maybe 10 days is about 40 points. And the gap up is 34 points. So almost a full day's range gapping up into the day. Also a gap, you can think of it just like any other breakout. It's a space between two prices. So the expectation is that the gap up will behave like any other bull breakout in this situation. It's probably going to get a second leg. However, look to the left, the context, the tight bear channel. The bulls are hoping for a major trend reversal. We have a gap up, breaking the trend line, but now we're probably going to get a test of the lows. And look at bar one, strong bear trend bar. Bar one for the bears, probably going to get a second leg down. So I expect the first attempt at trend resumption up for the bulls to fail, and I expect bar one to get a second leg down. So there's the first attempt at resumption, but it's a weak reversal. Reversal bar 2, but much smaller than bar 1, and then a doji bar 3. Expect sellers above and second leg down. Outside down 4, and then 5 breaking out. The bears get their second leg, 4 and 5. Now we're testing near support. What's the support? The breakout point, the high of this tight trading range. When we broke above it, in theory, anybody selling here gets trapped by the bull breakout. That creates support. Just imagine if you, in theory, traders selling here, if you sold here at this red line, the top of this trading range, you're trapped into a losing position. And maybe you scale in and sell more higher. When the market gets back to your original entry, you're disappointed with the fact that the market went far above your entry price if you went short, and you're probably going to buy back shorts. So there's support here. Plus you've got the moving average. So gap up above the moving average, market's pulling back to a couple of layers of support. Fairly tight bear channel down 1 through 5, weak buying pressure, so we may have to go more sideways before we go up. Inside bar 6, not a great stop order buy, probably sellers above. Breakout bar 7, pretty decent bar, but bad location, middle of a tight trading range. So tight trading range through here, expect sellers above, buyers below. Now the bulls have a decent micro channel, especially 7 and 8, they're decent bars. But once again, it's bad context. You look to the left, and last time the market was here, we sold off, breakout, pullback, second leg down. So there's trapped traders. Just imagine the stop order buy above 3 triggered, and anybody who bought above bar 3 trapped by this bear breakout. This bear breakout 4 and 5 may have to get a second leg down. I said the buying pressure through here was weak. It's a fairly tight bear channel, so we may have to go more sideways before the bulls get trend resumption. Now this is pretty decent buying pressure, good for the bulls, but bad location for buying. Tight trading range, you want to buy low and sell high, so there might be more sellers in this area, but I do think buyers will come in if we break out to a new low or somewhere in the lower third of this range. 9, a pretty decent breakout bar for the bears, but not great location, middle or lower third of this tight trading range, so expect buyers below. But this is confusing. The market's in a tight range. Better to buy low, sell high, or wait for something more clear. You can always wait for more information if you're not sure. An outside bar and then an inside bar. IOI pattern is a breakout mode pattern, but we already know the market is in breakout mode. It's already in a tight trading range for about 10 bars. And in this case, maybe the bears are hoping it's a bear breakout bar 1, bear trend, trading range, and then trend resumption down. But to me, the gap up is still stronger. It's a big bull breakout, the gap up. And this looks like the market is now going sideways. The bulls have not yet had their second leg up. So the risk, if you're selling here, to me, the risk is that the bulls are still going to get a second leg up. Bar 1 is currently the high of the day, usually does not remain the high of the day. So that's also a magnet that the market usually is going to test. We break below the IOI pattern, 13-14, but we're still in this tight trading range and we're testing support once again. I said the micro channel to bar 8 was pretty decent, but it was not great to buy up here, but there's probably traders buying down here. So we're testing that support where there's probably buyers, and now we have 2 legs down here. 9, pullback, and then this micro channel. 15, outside up at support, but not a great buy signal. And then 16, a strong breakout bar. Now that's decent for the bulls. Now the bulls have a breakout and follow through, reversing up from the bottom of a trading range. The bulls can argue it's a higher low major trend reversal. We've got the bear trend line break on the gap up, then a couple of legs sideways to down. The bulls can call it a high 2 or a double bottom, higher low bull flag, 15, 16. Double bottom with bar 5 and 15. And then 16 is a decent breakout bar. This is probably going to get a second leg up. We're hesitating here as we test resistance. The close of bar 8 is resistance. Maybe the high of bar 4 is a resistance level. But a micro channel to bar 17, a doji bar. The structure is good for, or at least reasonable for, a swing up. So selling below bar 17, a doji bar, after a pretty decent rally, not ideal. There's probably buyers below 17. 18, big breakout bar. Good for the bulls. The breakout is growing. There's been no pullbacks through here. We're approaching resistance. There's probably sellers at or around the high of bar 1. But this approach, the structure through here is pretty strong, 15 through 18. The bulls are probably going to get a second leg up. Any reversal will probably be a minor reversal and turn into a bull flag and lead to a second leg up. Another bar added to the breakout, 19 breaking out to a new high. Good for the bulls. Can they get follow through? And then we pull back on bar 20. It's an implied pullback. We did not fall below the low of the prior bar, but on a lower time frame chart, the market's pulling back. This is an opportunity for traders to buy. Pullbacks, part of the reason the market pulls back is because the risk gets big for the bulls. Traders buying anywhere through here, if they bought here, 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 anywhere, the stop is down below 15, so the risk is getting big. But the breakout is strong, and the odds are the first reversal attempt will fail to reverse the market very much. It'll become a bull flag, and the bulls will get a second leg. So traders can buy a bar like 20, betting on trend resumption rather than reversal. Traders can sell bar 20, but you're getting good risk reward. It's a fairly small bar at the top of a trading range, and if you're going to take a trade with good risk reward, you have to accept that you're taking a trade that likely has low probability of success. Small entry bar. This is good for the bears, at least they're getting a reversal and follow through, but this is still fairly small compared to the size of the breakout. And we look to the left, there's a breakout point. The high of bar 8 is probably support. Now after 20 and 21, the bears will probably get some kind of second leg down before the bulls get their second leg up. And we get more bars added to this micro channel, but the structure of the micro channel, not as strong as it could be. For the bears, lots of overlapping bars, big tails. On a lower time frame, it's a spike in channel with at least 3 legs down. So the bears, they're dealing with a bear channel line support, the breakout point support. So the downside here might be limited. And then just compare the strength of 20 through 23, the bear breakout, compare that to the strength of the bull breakout, and clearly the bull breakout is a lot stronger. The bulls have bars closing near their high, closing far above the highs of the prior bar. There's open gaps, like the high of bar 17 does not overlap the low of bar 19. That's a micro gap. Bears do not have those qualities or characteristics in their breakout. And it's against the trend. Gap up, double bottom, bull flag, strong breakout to a new high, probably a minor reversal, bull flag, and then second leg up. But this may be strong enough for a second leg down. But the problem the bears have is that this is a channel on a lower time frame. So we might already have a high 2 or a high 3 set up for the bulls. And 24, basically outside up, strong breakout bar. The market is always in long. I don't think we ever flipped to always in short on this breakout. So any trader selling for any reason, they have to exit above 24. And always in bulls can buy above 24. It's a reasonable bar to buy above. Reversing up at the breakout point support after maybe 3 legs down. And then 25, more follow through, good for the bulls, breaking out to a new high. Bears, they might argue double top 19 and 25, but the selling pressure is weak, especially 24, 25. Really no selling pressure that we can see. So better to either be long or flat here, expecting higher prices. Breakout will probably get a second leg up. Another bar added to the breakout, good for the bulls. The bars are uniform in size, closing on their highs. There's micro gaps. This is about as strong as a breakout gets. Whenever there's a breakout, I'm always looking for measured move targets. First one I'm looking for here, leg 1 equals leg 2. So 77.10 and a quarter. That's the leg 1 equals leg 2, measured move target. Then there's the opening range. And a measured move up based on the size of the opening range gets us close to yesterday's high. So there's layers of resistance above here. But this is a strong breakout to 26. It's probably by the close 24, 25, and 26. Important just to get long, even though your stop is far, it's below 24. The probability is very high, that the market's going at least a little bit higher before it reverses. 27, a smaller bar, so losing some momentum as we approach the leg 1 equals leg 2 measured move, but the approach is too strong to simply sell here. Sellers, like as far as selling above 27, I would not. There's too much momentum. There's probably buyers below 27, bad stop order, sell signal bar. 28 is a decent signal bar, but bad context. After a strong micro channel, the odds are the first reversal or the first pullback will lead to a minor reversal, a bull flag, and then a second leg up. But we are seeing some selling at that measured move target. And then a breakout bar 29, but a lot of overlap with the prior bar. Let's see, can the bulls get a follow-through bar? We also have at least 3 legs up here. So this is a breakout attempt of a channel, and then we're in the sell zone of the prior bar on the daily chart. Remember what I said. It's a bear trend bar. Yesterday we had the bear trend. So we're testing resistance. You look to the left and we're in the upper third of yesterday's range. So we're getting to a point where sellers may come in. Bulls look to take profits and bears look to sell. But we don't have to stop here. We can get to yesterday's high, but I suspect there's sellers above yesterday's high. And then 30, you can call it a second entry short, first reversal, second reversal. 30 is a reasonable bar for traders to exit longs below. As far as selling below 30, it's a low probability trade. You're still selling against a very tight bull channel. Traders can take the sell below 30, but they know they're taking a lower probability trade, and the stop probably does not go above 30 or 29 or even yesterday's high. It probably has to go higher because this could get another leg up, and if it does, there's probably sellers up here. Or instead of selling below 30, traders can wait for a bear breakout to increase their probability. And we get the breakout on bar 31, and that's good for the bears. So higher probability that we get a second leg down now, but the risk reward is worse. Your stop is further away if you put a stop here, and there's less profit remaining in the trade. But there's always that trade-off. When you wait for the breakout and increased probability, you're going to get worse risk reward. So second leg down likely, probably sellers above 31. And it's probably sell to close 32. Strong bear micro channel. Expect the first reversal to be minor. Expect the bear breakout to get a second leg sideways to down. Even if it pulls back to this high, there's probably sellers up here, and it'll probably get a second leg down. At this point, the market's either in a bear trend or a trading range. You do not get strong bear breakouts like this in a bull trend. It might be becoming a more broad bull channel, but even if that's the case, like I said, there's probably sellers up here. Another bar added to the micro channel, sell to close, sell above, reasonable. We finally get a pullback, and traders sell at breakout points. You got the low of bar 29, a strong bull trend bar. Traders buying at the low of the bar get trapped, and that creates resistance. The risk gets big for the bears. They sell a pullback as well. It's probably a 50% pullback also. So reasons for traders to sell in this area, expecting the bear breakout to get a second leg down. IOI, once again, breakout mode, but not enough buying pressure to reverse this bear breakout. The bear is hoping it's a bear flag. IOI, breakout mode, but selling below 36, not ideal. It's a bad bar to sell below. Inside bull trend bar, probably more buyers below. And we end up going sideways in a very tight trading range through here. So expect sellers above and buyers below, but expect in the bigger picture, the bear breakout is probably going to get a second leg down. And on the higher time frame context, sellers up here make sense. It's probably not going to be a strong bull trend day. And the price action today so far supports that. Trading range on the open, couple of decent rallies, but then a strong reversal here. We may have the high of the day. Tight trading range continuing. The bears trying to break out to a new low, but finding support at the bottom of the tight trading range. Limit order market, sellers up here and buyers down here. Very tight range, really not ideal trading conditions. Better to wait for something more clear, maybe wait for a breakout. Now we have a micro channel. Traders can sell here, betting that 47 is a bad buy. Bulls can call it a wedge bottom. 3 legs down, 1, 2, 3. Maybe double bottom. Breakout point over here. Rally, 1, 2, 3. Bulls can look to buy, but really not ideal. Not a lot of buying pressure through here. And this looks more like a reversal attempt, strong selling, than a bull flag. Clean up the chart. And this is a bad stop order buy, so traders can sell here and scale in, betting that we'll find sellers above and a second leg down. In this case, the micro channel continues. It looks like the bears are getting their second leg down after a tight trading range pullback. So in this case, micro channel, expect sellers above the first pullback. So 51. It's a decent looking bull bar, but it's a fairly small bar and the context is bad for buying. Expect sellers above 51, sellers above 50, betting that the first reversal will fail, lead to a bear flag and a second leg down. And we find sellers above and we start to get a second leg down. Breakout pullback, market begins to channel. So we might find some profit taking down here, but the channel is tight. So really not ideal for buying. And the channel continues here. We've got a bear channel line here. So the downside, bear's having a hard time breaking below the channel line. But the buying pressure through here is weak. It's still a tight bear channel, so only want to sell. This is a reasonable location for selling. This is interesting. We're testing the close of 55. Pretty decent looking bull bar, but after a 3-bar micro channel in a tight bear channel, probably going to find sellers above and a second leg down, and we do. So what happens? Anybody who bought 55 is trapped, disappointed, and then look what happened here. 57 rallied, pulled back, and then 58, 59 rallied, and then pulled back. That's 2 legs up to resistance. So reasonable sell below 59 or sell above 59. But this is a pretty tight channel, and there's probably traders buying below 57, taking profits. Bears taking profits at the new low. Breakout attempt below a channel line, probably going to fail, and this channel is more likely to evolve into a trading range than break out strongly. Late leg, at least 3 or 4 legs down here. But low probability buys. The channel down's tight, higher probability for the bulls to wait for a breakout. Now we've got a micro channel to 64, pretty decent rally. It's structurally different than anything through here that the bulls have had. 4 consecutive bars with trending lows, closing above the high of the prior bar. This is probably going to get a second leg up. 64, maybe buy the close, but not ideal. It's testing resistance. Traders who buy the close are betting on momentum continuing, but if you buy here, you have to be willing to scale in lower. There's probably buyers below. This will probably get a second leg sideways to up. Another bar added to the micro channel. It's probably buy the close and buy below, betting on a second leg up. Accelerating here, 66. Look to the left. There's resistance back here. So we're pulling back, 67, implied pullback. It's a good-looking signal bar, and it's testing resistance, but the approach is too strong to be selling against. The odds are the bull breakout will get a second leg up. Probably buyers below 67 and 66. 67 ends up getting its own second leg down, but this looks like a minor reversal. Just compare 67 through 70 to the rally. It's kind of like back here. Strong rally, weak sell-off, second leg up. Strong rally, weak sell-off, probably going to get a second leg up. It's 3 legs down, 1, pullback 2, pullback 3. So it looks like a bull flag, and what follows a bull flag is trend resumption, another leg up. Strong buy signal bar, 71, you could buy above that bar or buy in the buy zone of the bar. It's kind of in this tight trading range over the past 5 bars. Tight trading range continuing, but ultimately the bulls get their second leg up, and then the structure through here was, this is a weaker micro channel, lots of overlapping bars, tails, it's a channel on a lower time frame, breakout above a channel, testing resistance back here in the range, and then a strong breakout bar, 77. After a micro channel though, this may pull back first, but 77 is a strong bear bar. It's probably going to get a second leg down. We end up testing the breakout point, the low of bar 76 on bar 78. So we have a breakout, pullback, and then a second leg down. Probably support down here, buyers below 78. And we end up going sideways for the last couple bars of the day. Very tight trading range here. And overall, a trading range day. All right, for stop order trades today, bar 1's a strong enough bar for a second leg. Some traders might sell below bar 1, expecting that second leg down. But through here, stop order's not great. I don't think 6 was all that good. It was a fairly tight channel down. I thought the next best stop order was either above 15 or 16, a much better one. Breakout and then a strong follow-through bar. The context is good. Bull, breakout, the gap up, double bottom, bull flag. That's a reasonable stop order buy. Stop order buy here is more difficult. Testing resistance. Rather wait for the pullback. 24 is a reasonable stop order buy. It's buy the close 24, 25, 26. 30 is a stop order sell. For bulls, they can exit shorts below 30, and bears can sell below 30, or wait for the breakout on the next bar to increase probability. So 31, a better sell the close or stop order sell. This is sell the close through here, using the wide stop because the odds are any pullback is going to be minor and lead to a second leg down. Tight trading range, not ideal for stop order trading. If you are going to trade with stop orders in the tight trading range, it's better to trade in the direction of the trend that preceded it. So in this case, the bear breakout is the most recent breakout. This is strong enough to reverse this. And if anything, you're looking for stop order sells through here, betting that the bear breakout will get a second leg down. Micro channel, let's see. Maybe low 1 short below 52. The stop order signal bar is a doji, not all that great, but the context is good for a second leg down. Micro channel, weak buying pressure, probably going lower. I talked about 59 was reasonable, but traders are scalping out. And through here, not great. Maybe by bar 64, it's by the close, but even that's pretty difficult. Maybe 65, 66, the odds are at this point, you're getting a second leg up. I thought 71 was reasonable. 77, okay, but not ideal based on location, testing, support. The odds are it's going to get a second leg down, but better if you can sell the pullback. And then for limit order trades today, I thought because of the strength of bar 1, the first attempt at trend resumption would fail. Not ideal to sell above 2, but the doji on 3, that's a reasonable bar to sell above, looking for a second leg down. And then let's see through here. It's a limit order market, so traders might be selling above 4 and buying below 5, but we didn't quite get down there. They were buying at the breakout point, yesterday's bar 59 high. And then through here, probably buyers below 19. Bad stop order sell signal bar. You could buy below that bar. Betting on a second leg up. There's also this one. Bar 15, the big tail. And then 16 broke out above. You can see 17 pulled back, tested the high of that bar. Some traders will enter there. Strong breakout, buyers below 27, but we did not trigger that limit order buy, and then I would not buy below 29 or 30, too much risk of the reversal down, second entry short after 3 legs up on what's probably some kind of trading range day. Strong bear breakout, sell the close, sell above bars. You can sell above 34. It's a bad stop order buy. You can sell at breakout points back here, get filled on 35. Another tight trading range, so limit order market, sell in this area, buy down here. But once again, I don't like buying after a strong bear breakout and then a tight trading range. I'd rather be looking to sell to capture that second leg down. Micro channel, expect sellers above 51 or 50. In general, not as good to sell above a good looking buy signal bar like 51. Better to sell above a bear bar like 50, bar closed below its midpoint. Maybe sell above that bar, get filled on 52. Sell above 54, another bad buy. Sell above 57 or 58, also bad buys. You can still sell above bars down here, but the more bars that get added to the channel, the more likely the market is to reverse up. As bears become exhausted, they're taking profits at new lows, and they're going to wait for a correction before selling again. You expect the channel to evolve into a trading range. Strong micro channel, you expect the first reversal to fail, so you can buy below bar 68 or 66, although we didn't get there. I would not sell above these bars because you're expecting a second leg up. And I talked about this one briefly. Strong breakout 77. Traders will sell at breakout points like the bar 75 and 76 low, looking for 77 to get a second leg down. That's about it for the day. To learn more about price action fundamentals and how to trade price action, I would recommend you study the Brooks Trading course, which you can find at brookstradingcourse.com. There's a link to it in the description of this video. All right, thanks everybody for watching today's review, and I hope everybody has a good weekend.